How much of your portfolio should be in international stocks? 20%, 40%, 60%, maybe zero, maybe it should be 100% US equities? I'm going to come right out and tell you there's no right answer to this question. Even among investment professionals and financial advisors, the amount that you should have invested in international stocks varies wildly. For example, Jack Bogle himself, the founder of Vanguard, felt that you should have no exposure to international stocks, 0% international, 100% US. And he personally felt that Vanguard should not even offer international stock funds. Personally, I think that's a little bit far out there. I think all investors should have some exposure to international stocks, but what the hell do I know? I'm not Jack Bogle. So I'm just going to show you some data, some insight, some charts. I'm going to show it to you. We're going to look at it. I'm going to give my 2 cents and my opinion on international stocks and, well, how much exposure you should have to international stocks. You can ultimately decide for yourself. First, we will start right here with this chart, which is simply a Morningstar chart that shows the value of $10,000 invested in VFINX, which is the S&P 500, and EFA, an international stock index represented by the EFA ETF right here. The value of $10,000 invested 10 years ago, so that would have been March 9th, 2012. And we can see over this last 10-year period, US stocks have absolutely kicked ass over international stocks. No secret there, $10,000 invested in the S&P 500 would have grown to be $37,502.65 today versus EFA, $17,459. I mean, you more than doubled your return in the S&P 500. I think this performance over the last 10 years has a lot of investors saying, why should I even bother with international stocks? Clearly, the S&P 500 just kicks ass. And this is usually backed up by the justification that the S&P 500 has a pretty substantial amount of revenue from international sources. This chart right here from S&P Global shows that the S&P 500 revenue exposure by country is about 71% US and then 29% other. So by holding the S&P 500 or just investing in the S&P 500, you are getting some global diversification. All right? These two factors combined, personally, I think have a lot of investors feeling like they need to hold a lot of US equities, and holding international equities is probably not the best thing for them, because international equities, as you can see over the last 10 years, right, what we've got in our most recent rear view mirror, international equities just get their ass kicked and don't really do anything. US equities go up and up, right? At least that's what it seems when you look at this chart. But that is not always the case. This was something I didn't plan on showing you guys. I don't have a tab open for this, but let's just put emerging markets on here. Actually, I don't know if we can do this. I was going to say, let's just put emerging markets on here from the year 1990. So we'll look at 1990. January 1, 1990. And do we have the data? No, we don't have the data on here. So what you would see here, and what I was going to show, is that if we looked at it through this time period, US equities through the 90s really outperformed, and then emerging market equities underperformed, but then in the subsequent decade, things were reversed. So let's go on to the next chart here. This shows the performance of the MSCI World excluding USA Index against the S&P 500 decade by decade. And we can see that it varies from decades. In the 70s, international equities absolutely smoked the US. In the 80s, international equities did a little bit better, returning 20.17% or 20.7% annually versus 17.6%. And then in the 90s, the US equities, we had the tech bubble. At least in the late 90s, we really had the tech bubble. US equities just absolutely smoked international equities, 18.2% versus 7.1%. And then in the 2000s, international equities outperformed. The 2010s, US equities outperformed, as we basically already saw from this last 10-year chart here. And this really just shows us that things kind of flip-flop, right? There's not really one that necessarily always outperforms. In fact, when one has had a really good 10-year run, the other one tends to do much better. And then there's the CAPE ratio. The CAPE ratio is the cyclically adjusted price to earnings ratio. I know Rob, our Not With Research affiliates, has done a lot of research into the 5-year forecasting or 3 to 5 year forecasting or 10-year forecasting. I'm not exactly sure the hard numbers on it, but he's done a lot of research into the forecasting ability of the CAPE ratio. And basically what he's found is that stock indexes that have a lower CAPE ratio, a cyclically adjusted price to earnings ratio, tend to do better over the subsequent, I think, 5 or 10-year period. And here we can see the US cyclically adjusted price to earnings ratio, CAPE ratio here in blue, and the all world index, excluding the US, down here in black. US stocks have a much higher price to earnings ratio is what this is showing. So for your dollar, when you invest in international stocks, you're getting much more earnings. You're buying more earnings with your dollar than you are with US stocks. Essentially, you're buying value when you buy internationally. So possibly this means that international stocks are going to outperform going forward. Not necessarily, does not mean that every time. It also could mean, like that you're going to be on a pain train, right? So if you started looking at this back here in 2014, saying, okay, US stocks are getting overvalued, we're going to invest in international stocks or allocate more to international stocks. Well, in this time period, US stocks have continued to rip roar up, right? So it's not a defined rule. As with anything in investing, it does not happen 100% of the time. Okay, let's just look at the performance of these asset classes over various periods of time here. Let's just go back on this chart as far back as we can go. We're going to look at US stocks, global stocks, so excluding the US stocks, and then emerging markets specifically. I keep putting emerging markets on here, and there's a reason for that. Or I keep coming back to emerging markets and mentioning that there is a reason for that, which we will get to. So we can see over this time period, which is as far back as this can go, 1995, US equity is rip-roaring up here. And basically over the whole time period, US equities are basically on a high point. Now we know this is not always the case, because if we go back to this little chart, we can see that international stocks outperformed in the 70s and 80s. So even though we have what is essentially here a 27-year time horizon showing US equities outperforming, and it looks like US equities are the unanimous winner, they don't necessarily outperform all the time. And I always have to stress that. There have been time periods when they didn't. Who's to say that we're not going to see the next 20-year period being international equities being the ones that rip roar up? So keep that in mind. Let's also look at this from the year 2000 onward, right? This is going to be very interesting. So if we look at this from the year 2000 onward, we can see that this yellow line here, which is emerging markets, has done nearly as well as the US stocks. I say S&P 500, which basically that's going to do about the same thing as US stock market here, right? So $10,000 invested in any one of these, invested in emerging markets would have grown to be $39,265 today, whereas US stocks would be $47,135. So emerging markets came pretty close and was actually outperforming US stocks up until basically the last 2 years. Right? So that's really kind of interesting when you look at these charts, like what I pulled up on Morningstar. Mind you, this is not emerging markets, but over the last 10-year period, it doesn't seem like if we put emerging markets on here, and I do have that's this turquoise line down there, has really gotten its ass kicked. It hasn't really done much. In the 2000s, emerging markets did a lot, right? From this period here, from 2000 to 2009, they doubled in value. They went up from $10,000 to $24,634. They had a 150% return in that time. So emerging markets did really well there, although for the last 10 years they have not. But what I'm pointing out here is that there's diversification value in emerging markets, and I know I was talking about international markets when I started this video. They have done okay, but they have not done near the level of US equities. Emerging markets has done things differently. All right, so the big point here is that at different periods in time, international stocks do things differently, and they may outperform, they may underperform US equities. Let's just talk about correlation among asset classes, because this is where I'm going with my emphasis into emerging markets. The lowest correlation among equity asset classes is going to exist among US equities and emerging markets. So when we look at this chart right here, this just shows correlation of asset classes over this period from January 1st, 2008 to December 31st, 2021. It shows them over this time period. Correlation is always measured over a time period. And the correlation basis is on annual returns. And it's using ETFs to analyze these. So for the S&P 500, it's using the iShares ETF IVV. And we can see its correlation with other asset classes, right? So mid cap 0.95, small cap 0.92, iShares EFA ETF 0.93. What is this? iShares MSCI EFA small cap. Okay, so international small caps 0.88. I was seeing small caps. I'm like, well, we already had small caps on here. This is US small cap. This is international. And then emerging markets at 0.71. Basically, the most uncorrelated equity asset class you can find, uncorrelated to the S&P 500, is emerging markets. So I think there's a lot of correlation value there, or a lot of diversification value because of the lack of correlation in emerging markets. We can see that international markets, international stocks represented by EFA have a very high correlation to US stocks, right? So I think that when you look at it in that context, no, there's not a lot of value in holding international stocks unless you are going to go to emerging markets. It's my 2 cents in my opinion. That is not financial advice. That is just information, not financial advice for you to use to make your own financial decisions. The disclaimer, always do your own due diligence before making any financial investments. Anyways, let's look at how these portfolios would have performed here. So what I'm going to do, I'm just going to put US stock market 50%, and then I'm going to put global stocks 50% excluding US. And then we'll just do one of 25% US stocks, 75% global, and then 75, 25. Okay. So we'll run this analysis here, and this is rebalanced annually, I believe is what the default should be. Yeah. Going back to 1986, what do we got here? This is, again, based on the growth of $10,000. Investing in 75% US, 25% globally, you'd get a 10.06% return annually in that portfolio. That's going to be the highest returner over this period of time. It's going to lead to a final balance of $320,000. The lowest performer, as we could probably guess over this period of time, would be the portfolio with 75% international equities, 25% US equities. It had a compound annual growth rate of 8.14%. So that is not even 2% less than the 75 US equities, 25% international. I think this is important to point out, not even 2% less, but look at the difference in terms of final balance. $169,000 versus $320,000. That difference is fucking huge. 2% means a lot over a, 30, 40 year time period, almost 40 year time period here. It means a really, really big difference. If we were to put 100% equities on here by the S&P 500, well, we can do that. There we go. We can look at the chart. Yeah, that is the green line over this time period again. It has certainly outperformed all of them. All right. Now let's change things up though and add some emerging markets into it here. What if we just did emerging markets at 25% to represent our exposure to international stocks? And this is my own personal favorite, right? Like we know that, or we don't know, but we've seen US stocks do incredibly well. We know Bogle does not like holding international equities. Buffett is also another one of the big names that does not like international equities, right? And we also know that US equities have a lot of revenue from foreign sources, from global sources. And we also know that revenue is probably growing with globalization and more economies kind of merging together, right? Correlation among these equity asset classes are growing. So, right, what if we did 75% US stock, 25% emerging markets? Well, we can see that portfolio here. That is portfolio number 3. And now what time period do we have? We have January 95 to February 2022, so not quite 30 years, like 26 or 27 years. We can see that portfolio, number one, over this time period, outperforms doing 25% US, 75% global, or 50-50 US, 50% global. Let's just change this up, though. I don't like this 25% US stock market, 75% global. I'm just going to put 75-25 global, not specific to emerging markets. Mind you, the global portfolio excluding US stock does have emerging market exposure, but it's very small. So in these portfolios going back to January 1995, we can see portfolio 3, which is representative of 75 US, 25 emerging markets, had the highest compound annual growth rate at 9.94%, compared to, we can compare that to 75% US, 75% US, 25% international, which doesn't have any, or does not have specific direct emerging market exposure, had a 9.33% compound annual growth rate, and then 50% US, 50% global, had 7.9% annual growth rate. We can see the total value here, $10,000 invested in portfolio 3, 75 US, 25 emerging markets, would have grown to $131,000, $139. The S&P 500 would have grown to $155,000, so thus outperforming both of them. Finally here, let's see, what else can we do? Oh, there is the VT ETF, Vanguard's Total World Stock ETF. This one is interesting. We can talk about this here, and I'll just open this up and go VT ETF. What does market capitalization say about all this, ultimately, is what I'm trying to point out here. Because VT is Vanguard's Total World Stock ETF that is primarily based on market cap weighting. I can't find anything else out there. And it holds basically at market cap. It is holding 62% in North America. That's going to be US and Canada. Primarily the US because the Canadian stock market is very small. Oh, here we got a country breakdown. We'll just look at this. United States, 59.3%. So we can, from that, assume that Canada was about 3% of the world. United States, 59.3%. So about 60% in US, and emerging markets about 10%. So it's about 60% US, 40% international if you are just trying to do the true market cap weighting split. And for that, you don't even need to watch this video. You don't need to make any conscious decisions. You could just invest in the VT ETF. So market cap is about 60-40 right now of US to international equity. So yeah, my own thoughts and opinions on this, my own 2 cents, is that, well, you probably should have some exposure to international equities. I like to keep it small, and I like to keep it into emerging markets for my international exposure because they're the lowest correlated asset, or the lowest correlated equity asset class to US equities. Now, before I sign off, there's one other thing I want to share with you guys here. If this topic is of interest to you, this video I think would be good. And this is one I did where we look at 40 equity portfolios from 40 institutions. And they've got various exposure to US equities and international equities. And it basically said, hey, what would happen if we applied a 1% fee to the best performer? And suddenly, of all these or not of equity, but there's bonds and other asset classes in here. But of all these asset allocations, what if we took that 1% fee, put it on here, and suddenly it takes the best performer and makes it the worst? So, while you might be fretting over your asset allocation, fees have a much more substantial impact on your portfolio than your asset allocation. So on that note, guys, I'm going to sign off. If there's any key details that you feel like I missed on this topic, Let me know in the comments below. That's a wrap on this one, guys. I hope you found it helpful and insightful.